All right, let's get right into it. Deep inside the world of digital money, there's this huge debate going on. And it's not just about which coin is going to be the next big thing. Nope. This is a battle between two totally different technologies, two competing ideas for how money should even work. And believe me, there are billions and billions of dollars riding on the outcome.
So you might be thinking, okay, why should I care about some technical debate? Well, because the digital economy this thing powers, it isn't some niche tech nerd thing anymore. It is becoming a massive part of our global financial system, and its growth is absolutely explosive. Get a load of this number, 659 million. That's how many people are estimated to own crypto around the world right now. I mean, we're not talking about a small club of early adopters anymore. This is a huge global movement of investors, from regular folks all the way up to the biggest players on Wall Street, and they are all placing their bets on this new kind of asset.
But what are they actually investing in? What's the real technology under the hood that gives these digital things their value and keeps them secure? To really get this debate, we've got to understand the engine.
And it really all comes down to the blockchain, or more specifically, how a whole network of computers all over the world agrees on what's true. The secret sauce, if you will, is something called a consensus mechanism. Just think of it like the official rulebook. It's how thousands of computers agree on every single transaction, without needing a bank or some central boss to tell them what to do. This agreement, this consensus, is literally what makes the entire system hang together.
And this chart here shows you the basic path. Someone wants to send a transaction, it gets packed up into a block, and then the whole network checks it to make sure it's legit. If they all give the thumbs up, that block gets chained on forever, creating this permanent, unchangeable record. But how they agree? Well, that's where things get really interesting, and where our two biggest players go in completely different directions. First up, you've got Bitcoin's way of doing things, proof of work. The best way to think about this is like a giant worldwide lottery. You have all these super powerful computers, called miners, all competing 24/7 to solve this insanely hard math problem. The first one to find the answer, and we're talking about guessing trillions of numbers a second, gets to add the next block to the chain and gets a reward of brand new Bitcoin. It's a race that burns a mind-boggling amount of electricity. Then you've got the other way, which is what Ethereum uses now, proof of stake. Here, instead of a race to burn energy, people called validators put their own crypto on the line as collateral. They stake it. The network then randomly picks one of them to create the next block. The more crypto you staked, the higher your chances of getting picked. If you do your job honestly, you get a reward. But if you try to cheat the system, the network automatically takes and destroys your collateral. It's security through having skin in the game. So you see, these two different approaches, proof of work versus proof of stake, they lead to completely different results for things like speed, energy use, and even security. And that is the heart of the great crypto debate right there. Okay, so let's check out the scorecard. You can see the trade-offs almost immediately, right? On one side, you have Bitcoin's proof of work. Everyone agrees its security is rock solid. It's been battle-tested for over a decade. But that security has a huge price. It's slow, eats up an insane amount of energy, and the fees can go through the roof when a lot of people are using it. On the other side, proof of stake is built for a totally different goal. It's way faster, can handle way more traffic, and it's incredibly energy efficient. But it brings up new questions about whether the richest players could end up having too much control. And I mean, just look at this chart. The difference in energy use isn't just big, it's astronomical. Bitcoin's network uses about 125 terawatt hours of electricity a year. That's more than entire countries like Argentina or the Netherlands. But after Ethereum switched to proof of stake, its energy use dropped by over 99% to almost nothing. It's not even in the same league. So how can they both be secure? Well, it all boils down to economics. With proof of work, security comes from a real-world cost. It would be ridiculously expensive to buy and power enough computers to attack the network. For proof of stake, security comes from a financial cost. You'd have to buy a huge chunk of all the coins to get control. And if you tried anything funny, your massive investment would get wiped out. Two different ways to make cheating really, really expensive. And when you look at performance, it's kind of like comparing a quiet country road to an 8-lane superhighway. Bitcoin's proof of work can take 10 minutes, sometimes longer, just to confirm one transaction. Meanwhile, proof of stake systems like Ethereum can do it in seconds. As you can see, Ethereum is being built from the ground up to be this high-speed system, whereas Bitcoin needs these extra layers of tech built on top of it to handle a lot of traffic.
But here's the catch. Neither system is perfectly decentralized. In the proof-of-work world, just a few giant mining pools control most of the computing power. And in proof-of-stake, a small number of big staking services control a huge slice of the coins. And that really matters because the whole promise of crypto is that no one is in charge. These big pools could become points of control or censorship, which is exactly what this tech was designed to avoid. Now, this whole technical discussion isn't just for a bunch of engineers in a lab. These differences in speed, cost, and energy have massive real-world consequences, especially now that the biggest financial institutions on the planet are finally jumping in. And you can bet they are looking at these core designs to decide where they're going to park billions of dollars. So get this, financial analysts are predicting that the big players, we're talking major banks, hedge funds, wealth managers, are on track to pump an estimated $120 billion into Bitcoin by the end of 2025. And that's just the start. Because if you look just a little further out, the total amount of money from institutions, big corporations, and even some countries could hit over $426 billion by the end of 2026. This isn't just hype anymore. It's a fundamental shift in how global finance works. And this quote from a recent industry report just nails it. It perfectly captures the new mood on Wall Street. The feeling is clear. Doesn't matter if you're a small-time investor or a country managing its treasury, pretending this asset class doesn't exist is now the risky move. So where is all this headed? What does the future actually look like when you smash these two competing technologies together with this tidal wave of money from Wall Street? Well, for one thing, the story is far from over. We're already seeing new blockchains pop up that are trying to mix and match to get the security of proof of work with the efficiency of proof of stake. There's this whole new world of finance being built on top of Bitcoin, things like lending and trading. And maybe the biggest deal of all, more and more public companies are starting to treat Bitcoin like digital gold, adding it right to their balance sheets as a long-term asset. And all of this leads us to the final and most important question. The lines between the old world of finance and this new digital one are blurring faster every single day. The technologies we just looked at, proof of work and proof of stake, are literally the foundational rails for whatever this new system becomes. So the real question, the trillion-dollar question is, as these two worlds merge, who is ultimately going to write the rules for the next generation of money?